Good morning. Wow, this is loud. I feel like I'm on a congressional hearing. So, more so than a fireside chat. Hi, I'm Steve Kahl. I'm a professor here at Tuck, where I teach entrepreneurship. And today, we're very fortunate to have Hans Morris from NICA. I'll let him introduce himself. You'll understand once you hear his background why we're very lucky to have him here to tell us about FinTech. But in the spirit of entrepreneurship, about 20 minutes ago, we completely reconfigured what we were going to do. One of my
pivot. We pivoted.
It's a pivot, yes. We may even pivoted twice. One of my pet peeves with talks like this is the way they typically go is we sit here and talk for a while and you might fall asleep or pay attention a little bit and then we engage at the end. We're going to change it around a little bit and we're going to make this an interactive session. First, we're going to let Hans tell us a little bit about what's kind of hot in FinTech right now, and then they have a very interesting investment strategy and framework that they apply to think about investments, and we're going to work through that together and apply it to a specific case in the credit world. So does that sound? It sounds good. It's going to be a lot of fun. For those of you who have had me, we're doing exercises today. All right. But first, Hans, please.
Okay, so I graduated from Dartmouth in 1980. I worked in the Tuck Library for 3 years, photocopying works for professors and checking out books. And then I started working at Smith Barney as an analyst in 1980, and that company morphed into Citigroup. So I started out doing cash flow-based finance and public finance, so housing bonds and student loan bonds in the early 80 to 86. And I moved into mortgage and asset finance. I became head of that group. Sandy Weil bought Smith Barney in 1988. So Jamie Dimon was the 29-year-old CFO. A lot of other really great people worked there. I think there's like 25 CEOs or something that came out of Willie Travelers Group, and including Frank Bisignano runs First Data, and Bob Lip, and Jay Fishman ran Travelers, and Ajay Banga, Charlie Scharf, who's head of Visa, was the head of planning and analysis at age 25 or something. So really quite a great group. I learned a lot. I'm going to talk about Lou Glucksman a little bit later. And then Lou made me head of the financial institutions group in the investment banking group when I was 29, which was kind of crazy thing to do. We ended up, I had a strong point of view about information. Information costs were the source of competitive advantage. Competitive advantage of information drives the profit pools in financial services. So remember that fact. I'm going to come back to that. And so most of your profit pools, if you're lending money or insuring autos or you're trading bonds or investing, you don't have competitive advantage of information, you basically do less well than the mean, and if there's perfect information, there'd be no margin. So information costs have declined dramatically, so what does that mean to all those profit pools? We'll talk about that in more detail. So I ran that group for 10 years. We bought Shearson, we bought Travelers, we bought Salomon Brothers, we merged with Citi in 98, and I became the chief operating officer for the investment bank, which was mind-bogglingly complicated at that time. Merging Citigroup and Travelers, creating Citigroup, Citibank, and Salomon Smith Barney were like China and Canada merging or something in terms of like cultural differences. And
a lot of synergy, I think.
And then after we went through, there's some disaster happening every couple of weeks, it seemed, and then I became CFO in the thick of all that, of the institutional part. So that was the corporate bank, Salomon Smith Barney, the broker-dealer, the transaction services business, and there was $1.6 trillion balance sheet, $33 billion in revenue, and 62,000 employees in 100 countries. So there's some disaster happening every day, it seemed, some problem. And then the luckiest thing that happened to me is in 2007, I was recruited to become president of Visa as that was doing its restructuring. So I moved to San Francisco in June 2007, before the financial crisis happened. And So I was there during that. I was not CEO, I was president, but we took it public in the largest IPO in history at that time. And then I didn't get the CEO job, and I left and joined General Atlantic, which is a big growth equity firm, and we became head of financial services there. So I was there for 4 years, and one thing I felt is there's a huge gap in venture, which is there were now hundreds and hundreds and hundreds of FinTech companies, and which is a very big change. And but none of the venture firms, even really great venture firms, were experts on the financial system. So even super successful firms like Sequoia and Benchmark and Norwest Venture Partners and NEA and Matrix and all of them, none of them, like you could go in and ask a basic question, ask a partner like, how much capital do you need to be a bank? And no one would know the answer to that. And I felt if we had a firm where it was just composed of experts, that was the source of our money, we would make better decisions, but we'd also help the companies a lot once we made that investment. So that was the idea of NICA. NICA stands for New York, California. Having lived in San Francisco, at that point, I felt that New York and California really didn't understand each other at all. So the venture community hated Wall Street, basically, and Wall Street thought that the venture community was a bunch of know-it-alls, and so really there was like a big just translation issue there, sort of like the beginning of Citigroup, and so I started NICA in 2014.
Fantastic, great. So we're going to talk a little bit more about your strategy in a moment, because I think it's very interesting and very very unique, and it will help us kind of think through the next big thing in FinTech.
Okay.
But first, let's hear about what you're seeing in the venture world in FinTech, and what is getting funded these days. So what's hot?
So this is a nice little chart, and you could probably expand this into 20 categories if you wanted to, but this was in one page I tried to summarize it. So payments has gotten lots and lots of funding, and historically, I'm going to go back 1 second. If you go to any enterprise financial, any technology company, so IBM or Oracle or Salesforce, or you pick any company, any of the top 20, usually financial services is 20 to 25% of total revenues. It's a giant category of spend, and financial services, in many cases, were the first companies to significantly computerize their operations in the 50s and 60s and 70s. If you say what percentage of the S&P financials are about 21% of the S&P 500, it's a higher percentage, it's like 26% of S&P 500 earnings. But in 2010, it was about 1% of venture funding. Okay, so it's a big fact. And historically, certain areas like enterprise Wall Street tech got zero venture funding, zero. It was almost always funded by angels, and then once it got some traction, it would get growth equity investors would do a lot of Wall Street tech stuff. So that was a big, but very little venture, lots of growth though. And then payment processors were historically a good area. So First Data was one of the largest LBOs ever. So lots of private equity went into payments because you had generally rising ships because of electronification of payments, so pretty steady cash flow, not necessarily tech-driven. Like I don't think anyone would say Vantiv or World First or First Data are great technology companies, but very good revenue sources. So payments get a lot around remittances, so TransferWise or Zoom, lots of companies there that are in the billion-dollar valuation. MPOS is mobile point of sale, like Square, Clover, Revel. Lollipops is an acronym I came up with, which stands for Linked Offers, Loyalty, Likes, Incentives, and Promotions on Payment Systems. Wow. So that describes 1,000 schemes, hundreds and hundreds of deals, and if anyone comes to you with some sort of loyalty incentive, say on your phone, you're going to be able to just walk in and do blah, 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 you should say all those ideas fail. Okay? Except in rare circumstances. The only things that work in payments, new payment things, is if you compete with cash. That's a key rule. So
why do they fail?
Because you can make a great video, but if you think about it, like how many people have used their credit, is anyone in this room used their credit card in the past 10 years and it didn't work? Your credit card. Use your credit card at a point of sale, it didn't work? Really? Because the point of sale system didn't work? I doubt it. Maybe you didn't, there's some, I'd say it's, like VisaNet went live in 1985, it's never been down, okay? They're processing like 45,000 transactions a second. It's never been down. 45 million merchants, never been down. So, but if you say, how many times did your mobile, like I use Apple Pay all the time, half the time in the cab, it doesn't, I'd say 10% of the time, it doesn't work. You end up using your card. And so the reason is, if you want, payments have to be seamless. If it doesn't work 1% of the time, that's way too high a failure rate in payments. And to get to 1% failure rate is really, really hard. So 99 or 5, if you go say 5 nines as a standard, that's a very hard standard to meet if you're a new company. And it also has to be ubiquitous. Like if you went and you say, can I use my whatever payment system, and say, we don't take that, that's not very useful to you. Meanwhile, merchants don't want new payment systems. It's the point of sale as a technology term. So the POS, as it's called, is a really complicated spaghetti mess. And big retailers have a 2-year backlog of things they want to put into the point of sale. So to do any change is really, it's a long and complicated and expensive implementation. You also need to train people who have a 30% or probably 300% turnover, who usually are minimum wage at the point of sale. So when someone shows up with some new payment device in a long line, it doesn't work, they don't want that. The other thing is that data security is a giant issue. I mean, the CEO of Target got fired because of a data breach. So boards of directors are saying, I want to know there's zero risk of a data breach with payment transaction data. That's a very hard standard to meet. And then the CEO of McDonald's told me, he says, 1 second on the line costs us $1 million. 1 second delay. A 1 second delay in McDonald's in the United States costs them $1 million in lost revenue. So therefore, if it doesn't work and someone has to then get the manager over, that's like a big problem. So so basically, it's you could describe it as a chicken and egg problem. I really describe it as a chicken problem. Like no merchants are going to accept your payment scheme unless you have a lot of users. And you can't get a lot of users. You basically get merchants to agree to do it. So all these incentive ideas have to start with seamlessness, have to start with ubiquity, then also getting people to incent to say, I'm going to match the interests of buyer-seller at the second to really influence behavior. That has proven to be very difficult thing to do. So I think some will get that right, but I believe it will be like the Googles or some big companies are going to get it right because the resources necessary. And a lot of giant companies have tried to do this, and they've even Google payments failed. Visa wallet, they spent $1 billion on probably. That's how many people use that? No one uses that. And so it's really hard to make that work.
Yeah, it sounds very cheap.
Yeah.
All right, let's hear about some other.
So these are a lot of other things. Just alternative credit we're going to talk about. This now with AI, I'd say every pitch we get, it now says, and we use AI to order lunches for the team. And so it's crowdfunding, I'm basically very negative on, by the way. If anyone wants to talk more about that, we can. Lots of PFM tools. How many people have used Acorns here, or Digit? We're investors in both of those. We actually just committed to invest in Acorns. I think there's a big area. Digital advice is also, I think, a very important concept. I think there's tens of billions of dollars of agents and brokers and advisors and other intermediaries, and the algorithms are better than the advice than the personal advice, and they're going to get better. And they also don't go out of compliance, they don't go on vacation, and they have better technology, so better tech experience, better UX. So that's a big, big area that we can talk about. There's lots of banking models. I think all these are going to fail pretty much too. Lots of infrastructure. So this is an important topic, and we could spend a couple hours just discussing this, but the infrastructure is really old. However, getting it to change. When I was CFO, Tech and Ops reported to me, and that was a $3 billion budget at Citi in the institutional businesses. I would say many of our core systems are literally now 20, 30, 40 years old. To change them is very, very difficult, and it's an important point to understand. which we could also dig into if we have time, as to why they're so hard to change. But it is, I'd say the decision to rip out and replace a core system at an insurance company or a bank, just that decision is about a 1-year analysis. And then once you implement that decision, I would say at a big company, like a global company, that might be 5 to 10 years of start to finish implementation. So to change your core, particularly a big core system for a big company, would be a couple $2 billion bet. So in the meantime, you got a lot of limitations on your core, on your activities because of the old cores. However, I think some of it will change. There's lots of insurance now, lots of Wall Street and securities. Big data is pretty ubiquitous given the amount of data inside a bank. Distributed ledgers, boy, this has evolved a lot. Again, I'd be happy to talk about this. This is a big topic. But in a nutshell, we don't believe that anyone who believes that a digital currency is a good store of value, I believe, is an ideologue. All right? So I don't think there's any rational argument to, if you say, I want to invest in Bitcoin because it's a good investment, I'd say it's not a rational argument. And however, distributed ledgers, the core idea, is a very, very powerful idea in financial services because the whole financial institution is essentially ledgers. That's what the financial system is. You say Fedwire, it's a ledger. What is the Federal Reserve? It's a ledger. What is Citigroup? A series of ledgers. What's your account at Morgan Stanley? It's called stock ledger, is the core system that manages that. So it is a very powerful idea. If you said, Citigroup, we'd have some giant systems, like a derivative operations system probably has $25 million a year in maintenance in it. JP Morgan has pretty much an identical system. And so does Goldman Sachs, so does Deutsche Bank. If we had just one system that was a single source of the truth, that would save a lot of money. You wouldn't have to reconcile all these different systems, which is expensive, hard. And so that's powerful, but that is a long haul question. And then red tech is suddenly new. A lot of people saying, well, why don't we get the regulators to start adopting more technology? And then lots of security issues. That's a massive, massive area spent. So,
fantastic. Yeah. Before we transition, are there any questions about any particular areas, or?
Did I miss anything?
Yeah. You good?
Okay. And then there's also, I'd say, there's the emerging market side of all this. As you see, like India payments are really hot right now, and the demonetization trend, and that's suddenly changed everything in India from a very low penetration rate to suddenly going high. So that's a big topic.
I actually have a quick question about something you said about the competitive advantage of information and how it relates to what you're seeing here, because obviously a lot of these ideas change the value of information or the speed of information. So what is it with the new technology? What is it about information that gives you that competitive advantage? Is it getting information before anyone else, or proprietary models that you can better automate?
This is in itself. We could spend a couple hours talking about this. But if you said, for example,
you got about a minute.
Yeah, I got a minute. So if you say on Wall Street speed and trading and signals, that's a very significant area. So data is, if you could say, I can take satellite images of cars in parking lots and see what's trending in retail. That's an old idea. That's like a probably 8-year-old idea or something. Yeah, that might be a powerful data signal. Does it really generate alpha, or does it become table stakes that everyone just needs that? So, like, what creates sustainable competitive advantage of information is a very important concept. To me, it has to be proprietary and you can't sell it. If you sell it, it gets commoditized. So the best example of competitive advantage of information, easy one to understand, is Google. Google does not sell information. And what they do is they have a product which is free, which generates a lot of proprietary data, and they have a different product, which is basically an advertising matching market, separate. They don't sell information. They sell a very different service, which is a derivative of the information that they've captured for free. They pay a lot, but it's free to the user. So we could talk about this. We're going to talk about competitive advantage of information and credit in a second, but we'll try and maybe talk about that more when we come back and ask you guys to make investment decisions. You need to think about that. It has to be sustainable competitive advantage.
Excellent. So let's start making that transition.
Okay, let's go. It's going to get this. Okay, so these are the areas we invest in. So we do payment solutions, alternative credit, digital advice and financial infrastructure. There's lots of companies here. I'd be happy to talk about them maybe in a little bit more detail. It's also interesting, by the way, that Jeff Crow is speaking at the same time. He and I are both on the board of Lending Club, and so that might be a different topic that we can talk about later, about how to manage a crisis. Okay, so alternative credit. Well, what are the key ideas? So we define it as saying either new models for lending to creditworthy customers and small businesses that have predictable cash flows. So in the United States, about half the households are very creditworthy, and there's a lot of data about them. So about 65 million households are, 700 or higher FICO scores, and they have health insurance, and they have jobs, and you can authenticate them pretty easily. They live in a permanent address, and the other half do not, okay? Data tools to improve insight into the people who do not. So about 10% of the mortgagors in the United States in 2009 went through foreclosure. So it's about 5 million households, 50 million mortgages in the United States. About 20% of all homes were more than 20% under market, underwater. And about most of those had more than 60-day delinquency. So if you have a 60 or 90-day delinquency on your mortgage, you have a bad credit score. And if you are like my brother, who was an architect and a partner in an architecture firm and reasonably successful guy, but he was divorced, he had 3 kids in college, he went through foreclosure, and he does not have a credit card, because it's hard to lend to somebody like that. And so, but if you can predict who's going to be good and who's going to be bad, goods from bads, in that 35 million households who might be creditworthy, that's important. So Credit Karma, has anyone use Credit Karma? That's a very good model, because that was saying, we'll give you free credit information, free credit score, and that became a pretty interesting signal about your intent to improve your credit score. So in credit, the old rule, behavior trumps financial data. Two people with identical financial, same income level, same debt level, one pays you back, one doesn't. It's due to behavior. How do you measure behavior? Credit scores do a great job of predicting the past. So if you think the past is going to be equal to the future, i.e. you have a job, you will get a job, they rank order credit very well. If you're going to be different in the future, something's going to happen good or bad, they don't predict that. So that's what maybe you could use data to do. So there's lots of models around that. There's lots of asset classes. We're going to come back to that. So term loans, payday substitutes, retailer-driven credit at the point of sale, student loans, mortgages, all kinds of business lending ideas, lots of tools and services. We have a fascinating company that uses machine learning to do collections. Say that we can actually do better than humans do on that. And so, and now with AI, it's like say now with niacin or something. It's like every company now uses AI, and then we've invested in these companies here. Okay, so we have these we have frameworks for investing. So it drives me crazy when people I'm a big believer saying, okay, what is your criteria? If you have 100 or 200 different data, credit companies that you're talking to, and we get usually about 20 inbound companies per week, just to get a sense of the volume of things. There are several thousand FinTech companies that have received venture money. So how do you decide? And you can say, well, management. Well, of course, management makes a big difference. But what other criteria? So we developed these criteria. So we have these rules. So first of all, any lending business has to have fair and transparent rules that don't trick the customer into a profitable relationship. So in other words, like hidden fees, it's free, 0% interest rate, but if you skip a payment, we then back charge you for all these things. A lot of payday lending schemes, I feel, basically are incented to keep you borrowing. And it's not profitable unless you keep borrowing. It's not profitable to the originator. There's many, many things that don't rely. It's not transparent. If all the facts were known, the borrower wouldn't do it. So we insist that we don't do any of those businesses. The best businesses incorporate credit in a seamless way into the daily activities of the company. So a good example of this, we have a portfolio company called Fundbox, integrates into the general ledger, and they create a graph of all the companies you've ever paid or been paid by. They also score you to how accurate you are and how fastidious you are about maintaining your ledger. Do you do all your entries at end of the year, end of the month? Or
you don't want to look at mine.
Exactly. And they score you, and they score all your counterparties, every receivable, every payable, and every receivable. And then if you have a receivable, you click on it, and it will say, we'll offer you 94 cents on that receivable, and the money's in your account that afternoon. That's a great integrate. It's creating a competitive advantage of information that no one else has. It's a compounding competitive advantage, in our opinion, and it's a seamless integration of credit. It's not, no one's going on the internet saying, I need credit. You don't invest in businesses that do that. And the issuer has to have an enduring competitive advantage of information and must demonstrate that over a cycle, because lots of companies say, hey, we have all these engineers, we built this model, and you say, yeah, but you back tested it for a few months, or enduring competitive advantage in loan origination. And then eliminate funding risk. So this is a key thing. So every 5 years in the United States or so, you have a, actually I'll do this question. So what does 1962, 1970, 1974, 75, 1979, 1981, 1984, 1987, 1990, 94, 98, 2001, 2008 have in common? Say that?
Economic downturn?
Not always. It's basically there's a liquidity crisis. So for periods of more than 6 months, there was no access to the capital markets in each of those times. So if you're in the capital markets, you say like, okay, suppose if you're a bank, you have to do liquidity testing, and say suppose we had no access to markets for 18 months. This is something we learned in a rather dramatic way at Lending Club. You have a problem, funding stops. So what do? You can't say, well, we run out of, we fold up, go home. So this is a key issue. On marketplace structures, the company has to accurately predict cash flows. You're selling those cash flows to investors. Asset class needs to be big enough that institutional investors care and will do the homework. And so in my view, it has to be, $10 billion or bigger with fairly standardized assets. And then the risk-adjusted returns are attracted to real money investors. I'll talk about Lou Glucksman. I'll show you his picture in a second. But he used to say, speculators are always on one side of the trade or the other. You need real money investors. But liquidity comes from having real people who need capital on a regular basis and people who are prepared to invest capital on a regular basis. What have we learned the last 5 years? I still think there's a big asset class, but not everyone's a good underwriter. It's proving that a lot of these companies are not good at predicting cash flows at all. And some of these data sets, you say, we use Yelp data to underwrite small business loans. Basically, it's proven to be meaningless in underwriting small business loans. Regulators are very focused on developments. I think that they are interested in it. They're not necessarily antagonistic. We got a big change in administration. No one knows what that exactly means. And what I'd say is a lot of this is not totally settled yet. And scale matters. There's very high customer acquisition costs in many of these models. Some of them don't have adequate capital generation rates, so they can't fund the balance sheet given the growth that they have, and lots of operational risk. And liquidity in this space is highly correlated. And that's my old boss, Lou Glucksman, who used to say, the whole key, the secret to Wall Street is learning the same lessons have to be learned over and over and over again, and no one's around to remember what happened last time except for me. So I am now Lou Glucksman, talking about 1966. And
so you use these criteria as a startup's coming in to pitch you. You're using this criteria in the background to evaluate.
Yes, and I'd say the 5 core rules. Those 5 core, go back. These lending business 5 rules, I'd say many companies fail all 5 tests.
All 5.
It's rare that someone meets all 5 tests. Very rare.
So did you have to pass 1, 2?
Sometimes we say, I like Lending Club doesn't pass all these tests, but I thought Lending Club was an extraordinary business model, great, excellent team. So there are other things which overcame that. They were very early. They figured a lot of stuff out, but they don't have what's their enduring competitive advantage in origination. I think they've built a brand, but they were basically doing online customer acquisition and direct mail. That's anyone can do that. So Okay, so let's take this test, and now let's pick a category. So who wants to throw out, what ideas do you have about lending businesses? Who has a good idea about what lending business would be ripe for a FinTech company? Yes?
Independent workers. 1 in 2 Americans will be independent of a single employer. The government is not able to capture that data because it cannot look at an individual tax receipt. So it's essentially invisible, but it's real in terms of a shift in employment. So I worked in this industry for many years, and one of the challenges was that workers have income that fluctuates. However, behaviorally, they're very successful people, but their paychecks don't look consistent. So from a mortgage standpoint, they're often in a very challenging situation. They might have 10 years in the industry, very, very high income, they fit the affluent category, but they're not able to receive credit for things that somebody with, in fact, a less attractive portfolio would be able to do. To me, that seems like a very...
That's a great idea. Yeah, it's an excellent example. Really is. And we've seen several ideas around that. And okay, so how would we apply these rules to that business question? And so first is, what are you lending? Are you doing a mortgage loan? So mortgages actually are highly, highly regulated in terms of the disclosures. And post Dodd-Frank, because don't forget, here's a holy shit statistic that you should all write down. In 2002 to 2007, there were 3 trillion of bad mortgages originated in the United States. 3 trillion. 2 trillion was fraud. 1 trillion was bad underwriting. 2 trillion is fraud. So people lying about their income, lying about the use of the property that this was their primary residence versus multiple residence, with complicit behavior by the brokers and originators, and then that all going to capital markets investors. So 2 trillion of that. So for good reason, CFPB was created, and they created a new rule about disclosure. So disclosure, but that's a key thing, because I think one thing that we would learn, and if we're doing mortgage lending, is that the idea, or what?
I guess that's a good one. Either that or business lending to expand your business, whichever one maybe you agree.
Okay, who wants to? Who else wants to shape this and make it? How do we want to define the product a little bit more?
I do business lending.
Business lending? Okay. So we're going to do small business. These are obviously small businesses. They can't get credit someplace else. And it's someone who's got a very volatile source of income, but perhaps high. So it's high standard deviation, but large, successful amounts. So you're right. A bank will not lend that. Will not lend against that. Banks have very strict rules about lending, and that is a valid issue. Most of them have and it's actually pretty consistent among banks, that they will have a credit scorecard, and usually the business has to exist for 2 years. The business can't be involved in, they have a whole list of things that they won't lend against, like they won't do like gas station loans because of environmental risk. So there's all this stuff that they won't do. But volatile, cash flow is a big issue. So how would you, how are we going to originate these loans?
You have to know where they're getting paid, right? So if you understand how they're getting paid, then you would have to talk to the person that is most likely to pay them. Either third-party employment structure, like a business management organization, or large customers that would typically engage with this type of consultant or contractor, somebody who's working in the knowledge industry. I think you would have to have access to that proprietary data in a way that other people don't, right, in order to make the decision.
So there's a couple models we've seen. So one is it's not a business loan, but there's one which many companies have tried to work out this better models of payday lending. And so there's one company which gets, and they lend a lot to Uber drivers and Lyft drivers. And they basically, they get you, the consumer, to log in, to give them access, give them your login credentials to the employer check-in system. You might say that's a really risky thing to do, but they do. People do that. Wow. And so they, in effect, know that you have worked those hours, or you have driven those miles, or done. There's a receivable. They're validating the receivable that you have, and And that you can also, they enhance that by getting mobile data so they can actually see through geolocation and other stuff, say where you've been. So did you go to work? They guess through heuristics where you're working because you're at a certain location 8 hours, a certain amount of time, and then you seem to go to another location. They guess that you're working. They get this validation of the income. They lend you against that up to a certain percentage. And they actually do a push debit transaction, so it's actually pushed right into your phone, so you can spend it immediately. So you could use your debit card, like on the side of the road, to pay for towing or something. And that business model, so that I actually think that's a very interesting business model because it's got it's fair and transparent. In this case, they charge 0 fees. So it's tricky. What they do a tip system. So if you like the service, you tip. I don't know, how's everyone feel about that?
It seems like you can't make enough from that to build a company, and there's a disincentive, right? Like you're going to have a first selection, so people who are less likely to pay you money for that money will continue to use it, and people who would pay more would go do something else.
Yeah. It's a tricky one. The tipping. We ultimately decided the tipping for us was we were worried how that would, once it got big, you'd get free riders on the system, and would that actually turn out to be fair and transparent in a way. We did think they had a really interesting competitive advantage of information that they were building up, and they had a very enduring competitive advantage in loan origination. And so they were getting a group of people people were coming to them, and they were getting a lot of insight, and they were, it was very seamless origination. The funding model wasn't, at this point, it's very small, but ultimately they will need to fund that with a lot of equity capital. How many people here have ever worked in a balance sheet, like a balance sheet lending business of some kind? Okay, and what type of, like if you were gonna guess, if you went to the rating agencies or you applied to standard like leverage ratios and stuff, and you're doing consumer lending businesses, how much equity do you think you need for every dollar? What percentage equity would you think you need for each dollar of assets? Who wants to guess at that for consumer business? Usually about 15%. Even banks now are basically, if they're investment grade consumers, it's 100% risk weighted assets. So for big, that's in the 12% or so range for a big bank, including all the supplements and everything. If you're doing non-investment grade, so below 650, it's 175% risk weight. So basically almost 20% equity to assets. So you need a lot of capital. You also need liquidity reserves. So that capital is just for credit risk. Then you have liquidity risk. You have to have a bunch of cash sitting around to fund in the teeth of a crisis. So you need a lot of capital for these businesses, which is why many people go to the marketplace structure over on the right, which is what Lending Club uses and Prosper uses, because marketplace structure, you don't need the same size balance sheet. Now, but as we learned in Lending Club, what do you need? There's 4 types of risk. Basically, they're big categories. Anyone know the 4 categories of risk? 4 big categories of risk. An enterprise risk framework. You have credit risk. You have market risk. So how to, if you're trading or taking, and but sometimes you're not necessarily a trader, but you still have market risk if you want to liquidate something. You have liquidity risk, funding in the teeth of a crisis, and most companies go bankrupt because of liquidity. All financial services companies go bankrupt because of liquidity. And the last one's called operational risk, which is a massive category. That includes data breaches, that includes internal employees stealing from you, fraud at the point of sale. Like, you basically have to go through, and you may, a big company would have thousands and thousands and thousands of operational risk elements that need to be measured and captured. So what I would say in marketplace structure, you need capital for liquidity risk, and you need capital for operational risk. You don't need it for market risk, and you don't really credit risk, but you have to show that you're good at predicting the cash flows of the investors. That's what you do for a living. So if you're off, investors stop buying your assets and you're dead. So you have credit risk in a certain sense, but it's not on your balance sheet. Now let's go to the business. Let's say it's a business company. So how could you get enough data? How do you get data to make your first loan? Because otherwise you could have your head handed to you here, right?
Loan origination that you're trying to understand first, or it's a competitive advantage of data, you'd have to have a way of tapping into a platform that has already acquired that data. So if you look at like Uber and the data that they have access to, if you wrote something that could tap that data, understand the flow of payments, and then provide a value proposition to the end user to share different data with you. So now you've provided value to both sides. Then you could, in fact, be the preferred person that the driver uses to perform some spot tasks, and then the preferred API connection to the platform that therefore has access to the data.
Yeah, I agree with you. I haven't seen a company like that.
So this means that are you trying to sell to Uber or the individual
To
then?
the individual, because like when you write an app, or you write a product, that's, let's say somebody pays.
It's got to be a different. I'll give you a good example. It's not the credit and insurance, by the way, are highly, highly related, and in about 2/3 of the states, you can use credit bureau scores to for auto insurance. Why is that? Why does that work? Does anyone have an opinion about that? Yeah.
I think it's an indicator of your risk, so it allows them to price you better. I mean, insurance companies are super focused on stratifying or tranching their risk so they can price you appropriately.
But why would credit be a good indication of your insurance
If
risk?
you have higher credit, it indicates that you're more careful.
This is a behavioral indication. So remember what I said about behavior trumps financial data. Totally true in insurance as well. If you're the type of person that replaces the shingle, deals with your roof and trims the trees around your house, and
man,
you are actually a better credit risk.
You're hitting home. We just had a tree fall in our house. So.
But it's here's an interesting company, which is a good it's an insurance company. It's called Zen Drive, and what they do is they capture driving behavior on your phone through an app, either Life 360 or through these fleet driver apps. They've now mapped 10 billion miles, and they can score everyone the data insights that they get versus what an insurance company gets about driver behavior. The insurance company gets, have you had an accident? So it's your driver record, your speeding, your ticket records, your age, your sex, and your zip code. And then the other big thing is the model and cost of repairing the car. That's a big factor. But if you said, okay, you live in Los Angeles, but you never drive on the 405, or you never drive at night, and you're not distracted driving, they know through the Zen Drive knows if you're talking on the phone or texting. You don't brake. You don't drive erratically. The level of insight is a factor of several hundred to one in terms of predicting risk. Several hundred. But it's interesting. It's a byproduct. They are basically going to they're going to the fleet companies and saying, we'll give you insight about risk in your portfolio, and we'll help you distribute. Eliminate risk is a better way of buying insurance. Just eliminate the risk, or have alignment of the risk between the insured and the carrier. So I think you can go to companies and say, look, we're going to deliver this for you. Tough initial sell. It's hard to just walk in and say, hey, we're a bunch of engineers, just got out of business school. Trust us.
Hey, we're running out of time, but I'll let you ask your question though. I feel we could do this for like another hour, 2 hours, which would be fun, but other people wouldn't like that. So why don't we have a time for maybe 1 or 2 more questions?
I'm wondering, I guess in a lot of emerging markets, they've tried to solve these problems by looking at more group-based loans, so where you have others kind of vouching for an individual, and especially when you're talking small farmers and so forth.
Yep. Well, behavior trumps, right?
Yeah. So in these cases, and in more Western communities, have you seen other models that way, where you have, especially with social networks growing and that being a big indicator of that? Have you seen any models where you can take some of that into Western lending processes to have others vouch for?
There are some. We haven't invested in. One of the issues in the United States, Fair Credit Reporting Act and all the fair credit laws prohibit discrimination on religion, sex, race, and one of the problems is that the Fed and the CFPB have taken the position that if you have disparate outcomes, the assumption is you have to prove there are not disparate outcomes because of your underwriting model. So one of the problems with these social things, or even like where you went to school, for example, it's not clear that where you went to school, if it turned out that if you went in, you said, hey, our engineers have studied this, and we found out that Chinese American women are better credit risk than Jewish American men living in Chicago. You could say, that's terrific, that's illegal to lend on that basis. It might actually be true. But if you said, well, I've come up with a interesting, I don't lend to anyone who goes to Bulls games because there's lots of Jewish American men that go to the Bulls games or something like that also might be illegal. So if you have a proxy for some other behavior thing or some other prohibited discriminatory class, there's a lot of risk that, and Ally paid a $100 million fine on this where they said, look, Art, they were accused that blacks paid a higher rate, and they said, not if you adjust for credit risk and our model that, is fair. They still paid the fine. So in the United States, there's risk of that. Outside the United States, you can, like in India, you can do whatever you want. I've met with we have an investment in a company in Nigeria. They determined that it's actually a couple of computer scientists. One's Nigerian who worked at Amazon. The other one teaches computer science at Stanford. And their model, they said, well, it's actually we don't lend to anyone with more than one wife, because multiple wives, really bad credit score. They look at what porn you look at. I mean, they look at everything. And so it's totally legal. You might say it's a little creepy, but it's legal. Outside the United States, there are in many of these emerging markets, you can do whatever you want. And we do this pro bono project with the Gates Foundation and on their financial services for the Poor Project. And we talked about this issue with Bill Gates and he said, I don't know how we can be judgmental about that. We should let everyone, it's like, who are we to decide what the right criteria should be in a different culture? So his view is like, let people control their data. So what he's trying to do, the Gates Foundation is trying to say, can we create a wallet where we even pay people to give us their data? So we can take over their phone and see a lot of stuff, including who they're lending to. The biggest positive variable in that Nigerian company, the most powerful thing is, are you creditworthy and who do you call? If you're creditworthy, you call other creditworthy people. So it is a social relationship. So outside the United States, that's actually better. The bureau scores don't really exist. So you have very, very, tiny percentage of the population will have bureau scores. So stuff like that is the way you need to build a better score.
Fascinating. So unfortunately, we need to call it to an end. Patrick?
So we want to thank you for coming today and something here for.
Great, thank you. Good one too.
And I'd like to thank the Center for Digital Strategies who help get Hans here, which is great, and help sponsor this. I'm supposed to read some announcements for you, and then you can get out of here. Thank you, everyone. Just a reminder, office hours continue upstairs until 11:30. We have a 30-minute break. Well, it's now about 25 minutes. Coffee or tea is located right outside these doors. The next panel in this room is Extreme Entrepreneurship, and Georgiopolis will have How to Innovate. Just a reminder that you'll hear a chime to let you know that when things are getting started. And thank you very much for participating in this panel. Thank you.